Hi, welcome back. In this session, I'd like to talk about how individuals with the best of intentions can sometimes create perverse outcomes. Outcomes that are the exact opposite of what they sought to do when they started on a course of action. Now, many of you are aware of what I think about ESG, and the answer is not much. I think it's an acronym that is oversold, overhyped, makes a lot of people rich, consultants, bankers, fund managers, but doesn't make a change in society. Now, during the course of my talking about and writing about ESG, one of the things that I get pushback on is that the problem is not with what ESG tries to do, but how it's done. That in fact, the answer to many of society's problems is not ESG, but impact investing. You're saying, what is impact investing? In impact investing, you invest with a social purpose, not just to make money, but because you want to create positive change for society. Now, defined that way, who can be against impact investing? It's human nature to want to change the world. And I think investors around the world through time have always thought about how can I do it when I invest. Now, the question I want to examine in this session is impact investing that's become a fairly large area of investing, drawing in investors of all stripes. What impact does impact investing really have? Or in the words of Clara Pellew, the lady who pushed Burger King in the 1980s, where's the beef? Where is the impact in impact investing? In doing this session, I'm going to start with two presumptions. The first is that whatever problem impact investing is trying to solve is real. Climate change, poverty, inequality, it's real. And the second is that impact investors start with good intentions. They want to make the world a better place. Now, some of you might say that's too much to give away on because there are people who push back on both those presumptions, but I want to focus this session on the mechanics of impact investing and what happens in practice when impact investors try to make an impact. So let's step back. What is impact investing? Impact investing, if you define it as creating social change, good for society while you invest, has been around for as long as you've had investors on the face of the earth. Investors in companies through the ages, some of them at least, have tried to create positive change while they run businesses, while they invest. What's different about impact investing is in the last 20 years, this aspect of investing that's always been with us has been brought under this umbrella of impact investing. There are funds with that name. There are nonprofits that track impact investing. And one of them, in fact, is this global impact investing network that tracks how much money is invested in impact investing and who's investing in this space. So let's start with that statistic. In 2021, impact investing, defined as impact investors do, invested more than $1 trillion, 1.16 trillion into markets and businesses. Now, where did the money come from? 62% of that money came from fund managers. Then you got foundations and banks, pension and retirement funds, family offices. But note that a big chunk of this money is not coming from foundations and charitable contributions, it's coming from fund managers. Now you're saying, so what? Now remember, we said impact investing is about making a change in society as well as earning a financial return. Now, one question worth asking before we dive into impact investing is what are these impact investors expecting to generate as a return from their impact investments? And the chart that I'm going to show you troubles me, and I'll explain why. This looks at the returns that impact investors think they will make from impact investing. And it's broken down by groups. Take pension funds and insurance companies. These investors are investing for impact, but they expect to earn a risk-adjusted return or more. In other words, they want to have their cake and eat it too. They want to make a difference for society without giving up any returns. Foundations, family offices tend to be more realistic, accepting returns less than a risk-adjusted return, but saying, look, I'm doing good for society. I'll come back and talk about why this might be at the heart of impact investing's problems, the belief that you can somehow do good without giving up something. Now, with that lead in, let's talk about how you can be an impact investor. There are three pathways you can take. The first is the inclusionary path. In the inclusionary path, what impact investors do is they look for companies that will create the benefits for society, make a change in a positive direction in whatever problem they're trying to solve, and invest in those companies. So if your climate change is your issue, you're going to invest in green energy, alternative energy companies. That's inclusionary impact investing. In exclusionary impact investing, if you as an investor own shares in companies that you believe are moving society in the wrong direction, whatever problem you've picked, you sell those shares. In fact, you might go further and say, I will never buy shares in those companies because they do bad, with bad defined by whatever your social issue is. That's exclusionary investing. You choose not to invest in bad companies. So inclusionary investing, you seek out good companies. Exclusionary investing, you shun bad companies. There's a third path, which is what I call the evangelist path. Here, activist impact investors buy shares in bad companies, companies that are creating damage for society, at least from their perspective, and then they try to change the way these companies are run. Now, to see how impact investing actually plays out, at least in theory, let's start with inclusionary and exclusionary impact investing. In inclusionary and exclusionary impact investing, the pathway to change in society is through the market price. So let's take inclusionary investing. You go out and buy good companies. In the process of buying these good companies, you push up their stock prices. Now, as you push up their stock prices, in effect, you're lowering the cost of equity and capital, which means that these good companies will now be able to invest more. They will be able to expand more. In exclusionary investing, you sell bad companies. And at least in theory, you push down the stock price. And as you push down the stock price, you push up the cost of equity and capital at these companies. And by doing so, you reduce their investment choices. They shrink, they grow less than good companies. So inclusionary, exclusionary investing, the pathway is through the stock price. Think about that for a moment and think about what can go wrong, but that is the pathway. In activist impact investing, you take a stake in a company. Unless that stake happens to be more than 50%, you by yourself cannot create change. But to the extent that you can form critical mass with other like-minded investors, you convince them to join your group, you can change the way the company is run. From the top all the way to the bottom, from the board of directors to how that company invests, how it finances itself. And what are you trying to do? You're trying to get these bad companies to do less bad things and more good things. In theory, you can see how impact investing should work. But what can go wrong? In fact, the real question is what cannot go wrong? Because a lot of things can go wrong. With each type of investing, I'm going to take rather than deal in abstractions, I'm going to take an example of climate change and show you how it plays out. Let's take the buy good business path, the inclusionary investing path. You're supposed to buy good companies and in the process push up their stock prices, reduce their cost of equity, and get them to invest more. Sounds good, right? But here's the potential perverse consequence. This presumes that you know what good companies look like. So in the example of climate change, that you know which alternative energies are going to really fill the gap, and then you supply these companies with capital. But what if you're unsure? What if one of the things you're doing in the process of trying to invest in good companies is you're investing in the wrong companies? In the context of climate change, you're investing in the wrong alternative energies. Not only is your capital being wasted, you might actually make it more difficult for the right technologies to develop because you've overcapitalized businesses you shouldn't have. So with inclusive investing, that's a perverse consequence, is you're investing in the wrong good companies. With exclusion investing, what can go wrong? Remember, by selling these companies, you hope to push down the price. Okay, let's say you accomplish that. You push down the price. You've essentially made returns on these companies higher for investors who might not have the same consciences that you do. Now, by itself, you're saying that's their problem, not mine. They have to live with their consciences. But here's the other possibility you have to consider. If you push down the prices for publicly traded companies or the companies you can target, You're making that business more attractive. You're creating a void in that business that others who don't feel the same pressures that the public companies do, private equity investors, privately owned companies, can step in and do exactly the same things you've stopped your publicly traded company from doing by pushing up their cost of equity. So the bad things happen anyway, and you have no control over them. With activist investing, where you take stakes, the first thing you have to worry about is, can I get a critical mass together? But let's say you do. You get your fossil fuel companies to invest less in fossil fuels, divest their reserves. Again, you have to worry about others stepping into the void, others who don't feel the same pressures and doing exactly what your fossil fuel companies used to do, but without the supervision of shareholders. You can have perverse outcomes. You're saying, which one's going to dominate? It's not a theory question. It's an empirical question. And in fact, there's no way you can conclude one way or the other without looking at the specifics of impact investing. So here's what I'd like to do. I'd like to take one aspect of impact investing, perhaps its biggest target, climate change, and use the data to see which is winning out, the good stuff or the bad stuff, the benefits or the costs. So let's start with climate change. As I said, I won't question whether climate change is here and the motives of people investing in climate change. But this is, in fact, I would say, a problem that seems to be tailor-made for impact investing. Why? Because unlike many other social problems, there does seem to be a consensus that the climate is changing, though there can be a debate about what's causing it to change and the solutions to climate change. But it's a problem that seems to be perceived as a big problem around the world. And second, many of the businesses that create the problem, at least are perceived as creating the problem, are publicly traded and therefore easily targeted. So climate change, if impact investing is going to work, this seems to be as good a place as any other. So here's what we're trying to see. We're going to look at the data to see if impact investing is having an effect on companies in the climate space, and more importantly, on the actual climate change itself. So let's start by looking at fund flows. It's the easiest part of impact investing, is to get the money going. Now, if you look at fund flows into green energy, clearly impact investing has had an effect. The amount of money that has flowed into green energy, alternative energy companies, is huge. But the last decade, more than $5 trillion has been invested in green energy or alternative energy investments, with a surge especially since 2020. So a lot of money is flowing into green energy. Now, coupled with money flowing into good companies on a climate change basis, impact investing has also worked to get fund managers, to get endowment funds to divest themselves of fossil fuel companies. This movement has picked up steam as well. If you look at by the middle of 2023, there were more than 1,600 funds. And it's not just endowment funds. Some are, pension funds, endowment funds, a whole stream of investors who have said that they will not invest in fossil fuel companies. And they control more than $40 trillion. So if I stopped right there and saying, is impact investing working on a fund flow basis? Clearly it seems to be, right? Money is flowing into good companies and money is flowing out, or at least not flowing into bad companies. But let's dig a little deeper. Let's see whether this is changing the market cap and pricing of these companies. The answer is, with green energy companies, the answer is yes. The market cap of green energy companies, which 20 years ago was close to zero, has climbed over time. In this chart, I have both the enterprise value and the market cap. You're saying, what's the difference? Market cap is just the market value of equity in these companies. Enterprise value is the total value. And the reason I'm counting both is, one form of impact investing is through green bonds, and the enterprise value should reflect it. So on a pricing basis, it looks like impact investing has played a role, at least, in pushing up the pricing of alternative energy companies to more than $700 billion in 2020, if you look at enterprise value. And since then, there's been a little bit of give back, but there's clearly been success, at least, in pushing up the number. You're saying, what about fossil fuel companies? Well, those divestment programs where investors were forced to divest themselves of fossil fuel companies? Is that having an impact? To answer the question, I've looked at the market cap of fossil fuel companies, coal companies, oil companies of oil, across the chain, and tracked them over time. So let's focus on the last decade. In the middle of the decade, there is a swoon in market cap. Market caps have dropped off. And while market caps have recovered, especially in the last 3 years, it's worth noting that if you look at the last decade, the cumulated growth rate, the annual average growth rate in market cap at fossil fuel companies has been low, 4.49%. Just to give you a contrast, the market overall was up 10 or 11% over the course of the year. So at least at first run, it looks like the pricing effect is playing out. Green energy companies have gone up a lot. Fossil fuel companies have kind of stagnated or not gone up as much as the market. Let's keep going. One of the wishes, one of the things that impact investors have hoped will come out of impact investing is a change in perception of energy companies. With green energy companies, they've hoped that by bringing money into these companies, investors will become more upbeat about the future growth prospects of these companies and price them higher. And at least at first sight, that seems to have happened with green energy companies. If you look at the multiple of EBITDA, it's been pretty stagnant, but if the multiple of revenues, investors are paying close to 6 times revenues for green energy companies, alternative energy companies, as opposed to 2.6 times revenues a decade ago. It looks like a win, right? Now, of course, there's an alternative explanation here, which is all this money, impact investing money that's going into green energy is too much money chasing too few opportunities, that we are in fact overpricing alternative energy companies. Let's put that to the side. At least looking at the pricing metrics, it looks like investors are paying higher multiples of revenues, at least now, for alternative energy companies than they used to. What about fossil fuel companies? Fossil fuel companies, to evaluate how much of an impact investing has, you've got to step back and think about the biggest driver of the market cap of fossil fuel companies. With oil companies, it's oil prices. This graph actually to show you how much oil company or fossil fuel company stock prices move with oil prices, I've looked at the market cap of fossil fuel companies against the average oil price each year. Do the two move together? You can see in the chart that they do. And if you don't believe your own eyes, I've computed the R squared between oil prices and market cap, and it's high, 0.69. So it's clear that much of the movement in market cap on a year-to-year basis comes from changing oil prices. Now you're saying, what next? I want to isolate the impact of impact investing. And to try to isolate the impact, here's what I tried to do. I tried to come up with what I'd expect the market cap to be given the oil price that year. In other words, if oil prices are $100 a barrel, I would expect the market cap to be higher than if they're $30 a barrel. You're saying, how do you come up with the expected market cap? I look at history. In fact, I used the previous 25 years of market cap and oil prices, that relationship, to forecast the market cap for the next year. So in this chart, the green column is the expected market cap. Remember, if impact investing is changing perception, here's what you should expect to see. The expected market cap should be much higher than the actual market cap. Why? Because the actual market cap will now reflect the downbeat views of the world, that the world has changed, that oil companies are now finite life companies which are essentially heading for decline and demise. And for a period at the start of the last decade, in 2011 through 2014, you can see that the actual market cap fell below the expected market cap, albeit by a small amount. But over the last 6 or 7 years, it looks like markets have recovered their feet with fossil fuel companies. Investors seem to have gone back to assessing oil companies with much better expectations for the future than they used to. Now, of course, this might be temporary. Impact investors could argue that investors are being short-term, but for whatever the reason, it seems like whatever that initial impact might have been of impact investing, it seems to have faded over time. And here's another chart that backs up that proposition. Here I've looked at the multiple of EBITDA and revenues that investors are willing to pay for fossil fuel companies. And you know what? The last decade, 2011 through 2022, when impact investing poured, divestment programs kicked in, and endowment funds got rid of oil companies from their portfolios. The bottom line is had very little impact on the pricing metrics. Now I know it's an early judgment to pass, but at least for the moment, impact investing hasn't changed the calculus that investors have when they look at oil companies and price them. Now let's look at whether impact investing has had an impact in changing the way fossil fuel companies behave. Let's start with pure operating metrics. Have fossil fuel companies been damaged by impact investing in operations? Well, there are three metrics I'm going to use to measure operations. One is revenues, the second is EBITDA, and the third is EBIT. And I'm going to compute margins over time. So if operations are being damaged, you should expect to see revenues get hit and margins come down. Did that happen for a period early in the decade, the last decade? It did happen, but again, especially in the last 3 years, fossil fuel companies have recovered. They've recovered in terms of revenues, in terms of margins, in terms of profitability. So again, the impact of impact investing, which might have shown up in the first part of the last decade, seems to be fading on profits. You're saying, what are they doing with all this money? And here there's a glimmer of hope for impact investing because they're not reinvesting the money. They're actually returning a great deal of these profits. Now, if you're hoping that fossil fuel companies will invest in green energy, that's really not happening in big amounts because a large portion of the profits each year are being returned either as dividends or buybacks each year. Fossil fuel companies increasingly returning cash. And at the same time, they're spending less on exploration, on the fossil fuel business. In fact, we know that fossil fuel companies, especially the big ones, were divesting fossil fuel assets, reserves over the last decade. Now, if you're an impact investor, this looks like it's working, right? Because after all, wasn't this the end game to get fossil fuel companies to invest less in bad stuff, fossil fuel reserves, to divest themselves of those reserves? You're ready to declare victory, but before you do, here's the bad news. The dark side of what's happened in this space. Those fossil fuel companies that you put pressure on to invest less, to divest, are doing that, but guess who's stepping into the void? It's private equity. This actually looks at the amount of money invested by private equity in energy. It's true that some of that money has been directed towards renewables, especially in the last year or two, but the bulk of the investment between 2010 and 2020 in private equity went into fossil fuels. And this actually understates the total amount because it doesn't count in privately owned oil companies, especially emerging market government-owned oil companies investing in. So forgive me if I'm being cynical, but it looks like you're getting publicly traded fossil fuel companies to step back from the investing, but stepping in are private equity investors. Now, if you declare that a victory, all the more power to you. But that doesn't look like a victory to me. In fact, there is evidence that activist investing that was getting so many victories in this space in the last decade is starting to lose its mojo. And I think I hate to use an event as the triggering point, but I do think in this case the Russian invasion of Ukraine laid bare the emptiness of the green energy claims that they were replacing fossil fuels, because it made clear to the world how dependent the world was on fossil fuels. So the aftermath, and this might be pure coincidence, this might have happened anyway, but it seems like it's not just a coincidence that fossil fuel companies have become much more willing to go back into the fossil fuel space. Petrobras, which in the last decade talked a great deal about how it was divesting itself of fossil fuel reserves, is now back in the fossil fuel game. Royal Dutch bought a stake in a Qatari gas field. BP, announced it was going to produce more oil and gas. ExxonMobil bought Pioneer, a shale driller for 60 billion. The fear factor seems to have receded. And institutional backing for activists is also dropping off as the big institutional investors, BlackRock, Vanguard, are stepping back from investor campaigns primarily around climate change. Now, all of this might seem like debate about markets, but let's think about the big story. After all, impact investing was not about getting ExxonMobil to produce less oil. It was about reversing or changing the way we produce and consume energy. And I want to ask the question, has that happened? Let's start with a very bare-bones statistic of oil consumption. If you look at oil consumption over the last 20 plus years, you can see that in spite of all of the news stories impact investing has garnered, not much has changed. Oil consumption has continued to grow. In fact, the pandemic in 2020 had a bigger effect on oil consumption than all of impact investing put together, and that COVID effect is fading as well. So oil consumption has clearly not dropped off. And if you look at where we get our energy, and this is globally where we get our energy, it's astonishing how little has changed over the last 50 years. In 1971, we got about 86% of energy from fossil fuels. In 2019, we got about 81% of our energy from fossil fuels. You're saying that's still good, we're moving in the right direction. Almost all of that drop was because of nuclear energy, which, if you think about impact investing in the last decade, that was the one alternative energy that was not a good alternative energy. Money didn't flow into it. That's been the primary reason we're less dependent on fossil fuels. Now, if you want to see this in more detail, I looked at energy sources in the US over time. And this perhaps is a monument to the futility of impact investing, at least the way it's been practiced over the last 10 or 15 years. Over the last 10 or 15 years, impact investing has talked the talk, spent $5.4 trillion to walk the walk, but over that period, our dependence on fossil fuels for energy has actually gone up, not gone down. Whatever we've gained in solar power or wind power or hydropower has been more than offset by the shutting down of nuclear plants that were producing a significant amount of energy. Now, impact investors can come up with excuses that it takes time, but I thought time is the one thing we don't have, that investors are short term. But if this is what passes as winning in impact investing, what we saw on those charts, I'd hate to see what losing looks like. In fact, what I see in the data is, reminds me of the old definition of insanity, which is you do the same thing over and over again, expecting a different outcome. Impact investing as practiced now seems to fit that definition. Throw billions into green energy, blame oil companies, make fossil fuel companies the villains, and each year our dependence on fossil fuels goes up. Now you remember with ESG, I have no desire to rescue that rotten acronym. But I think impact investing is always going to be around, and I think it can be rescued if we accept a more modest version, a less hubristic version of it. I have 5 suggestions for impact investors who want to rescue it. First, if you're investing your own money, of course you should consider impact investing because you got to live with your investments. I have a very simple test on whether your portfolio is right for you, and it's a sleep test. If you cannot sleep at night, you have the wrong portfolio. So if investing in ExxonMobil causes you to lose sleep, of course you should stay away from ExxonMobil. So if you're investing your own money, by all means, make impact investing part of the game. Pick the social issue that matters the most and invest on that basis. If you're investing other people's money, then first be transparent about what you're trying to impact and get buy-in. So if you start a climate change fund, you attract investors who care about climate change, of course. you're entitled to carry through on your promises. But if you are TIAA CREF and you've got my pension fund money and you decide to do impact investing without telling me what you're trying to impact, that's not right. And if you got the buy-in on what you're trying to impact, you need to specify metrics that I can use to judge whether you're actually succeeding. And whether you're investing your own money or other people's money, be honest with yourself about the trade-offs. Because there is a trade-off. Being good will cause sacrifice. Remember the chart about impact investing groups that expect to make a risk-adjusted return while doing it for society? Stop being delusional. I work at NYU, and just a couple of weeks ago, NYU announced that they were divesting themselves of their fossil fuel investments. Well, let's be quite clear. NYU divesting its fossil, NYU is not Harvard or Yale. Its endowment is small. Divest, I don't know what portion of that is in fossil fuels. Divesting those fossil fuel companies is going to have no impact on climate change. So be clear that you're doing this just to make yourself feel better. The case of NYU, it also strikes me as incredibly hypocritical that a university that has decided that its expansion is going to be in the Middle East with an Abu Dhabi campus, which is large and growing, wants to talk about climate change being the existential problem at the moment and selling its fossil fuel stocks. Stop being hypocritical. Fourth, like ESG impact investors, some impact investors are full of themselves. They want to cloak themselves in virtue, take the higher, argue that they're on, they've got the high road, they've got the answers. And I think that's not only is that going to alienate pretty much everybody else that you're trying to convince, it also means that you're unlikely to look at what you're doing and ask yourself, is it working? Because none of us has the answer to climate change. What makes you think that you've got all the answers? And finally, I know the profit motive is a bad term among many impact investors. They don't like it, especially if you go talk to foundations and charities. Profit motive is what's gotten us into and it's true, the profit motive might have driven some of the problems that you're trying to solve as impact investors. But it's also true that there is nothing more powerful than the profit motive when it comes to solving problems if you can harness it right. I know this is going to piss off a lot of impact investors, but let's face it. One man, Elon Musk, has done more for climate change than all of those people gathered together in Paris and Glasgow and the impact investing crowd have over their entire lifetimes. Let's face it, he's changed the way we think about electric cars. And he's done it not because he wanted to do good for society. That might have been a side benefit, but because he wanted to build the most valuable company in the world that's worth trillions of dollars. So I think that, we need all the allies we can to fight the problems. While much of what I said about impact investing was about the climate change component, impact investing can be directed at other social problems as well. And much of what I said about climate change applies there in spades. So if you're impact investing to reduce poverty, to reduce inequality, by all means do so, but be clear about what you're impacting with your impact investing, because it might not be what you think it is. I hope you found this session useful, and thank you very much for listening.